Thanks for joining us again today for another video about insurance. Today I'm on the couch with Aaron Zellman talking about income protection.
Professionally, I've been an insurance advisor since 2004, and what prompted me to get involved actually is I have type 1 diabetes. I was within the ANZ Bank at the time and I got exposed to this and I thought I want to get insurance for myself, struggled to get cover, applied my knowledge and thought this is something I was really passionate about and really cared about. And I've been doing that for getting to 14 years now. I've advised about 1,000 doctors. During this time I've had my own business focused on doctors, which is MediBroker, which has been acquired by Priority Life. That's really my professional passion. Aside from that, I'm a father of 4, husband to 1, and
husband to 1, that's important.
Musician, yeah.
Great. So income protection is an area I'm really passionate about as well. And so really my thoughts around it come from personal perspective. My husband was diagnosed with a terminal illness at the age of 33, and at that time we were probably about a year off getting income protection because we hadn't quite got to the stage of buying a house and that sort of thing. And I think we really didn't understand what it was about. So that's why I feel like this is a topic that's really important. It's really important for us to talk about. So let's start with, how does it work? What is income protection and how does it work?
Sure, alright. So just focusing on income protection now, not life insurance or trauma cover as such. Income protection is a policy that gives the policyholder their income back, a percentage, like 75% typically, of their income back for every month that they're unable to work for health reasons. It's called a monthly benefit. So just as a quick example, if you earn $160,000 per annum, you can insure 75%, which is $120,000 per annum, but we actually talk about it as monthly benefits, like $10,000 a month of cover. And the thing that probably 9 out of 10 people forget or just never knew is that $10,000 is still tax payable. You get the 10 and you've got to pay the tax on it.
Right.
So that's called the benefit. The key things to be aware of is there's a waiting period. So if you're off work for 2 days, you're not going to get a claim just for having a cold or something like that. You need to be off work for a certain amount, and you would work that out with your insurer when you go for a policy. For a lot of people, that's 30 days before they would typically get any money. It can be 60 days or 90 days or even longer. A lot of super funds just start at 90 days, and we can talk about cover through super in a moment. But so you've got a waiting period. How long do you typically have to insure yourself? And then the next big question is, how long do the payouts go for? Mm-hmm. Generally speaking, people have policies to age 65. So for every month, I've got a client a surgeon who developed Parkinson's in her 30s. So that's her financial lifeblood for the future, till 65 when her policy will expire. There's a trend these days to have policies to age 70. I don't always recommend that because I'm hoping that my medical clients won't need it between 65 and 70, and it's a bit of a hard one to crystal ball. Will you actually need the cover then or not? But that's a key variable. You can sometimes reduce it. You can have a policy to age 60 or even just 2 years, but the cost of it to age 65 is generally the same as one that's to age 60, for example.
So I think that's a good point that it goes to the age of 65, because there are actually a lot of packages out there that don't cover you for that amount of time. So people might think that they're getting a life's worth of income protection when actually you only get a year or 2. Is that right?
That's right. Commonly within super funds, they used to be capped at 2 years. Some funds will allow you to make it go longer, but you typically have to apply for that. Mm-hmm. And there's a lot of pros and cons with having your cover through one of the super funds with what they offer. A simple way to put it is, even though you might be with a healthcare oriented fund, the policies themselves are not very doctor specific. There can be quite a few issues with those policies. They're quite technical points, but it's really worth, at least if you're going to consider one of those policies, at least compare it to what I call an individual policy. Sometimes it's called a retail policy. The more comprehensive policies out there, and just work out which way to go.
So in terms of where you can get your cover from, there's getting it from a bank, getting it through your superannuation fund, or getting it through a sort of retail insurance provider, like one of the big sort of,
Yeah, well, the policies, there's 10 major insurance companies in this space. They offer the individual covers. Now, they can be purchased directly. You could go to AMP or MLC or ComInsure and just say, I want a policy. They'll send you the quotes and the paperwork. You can do that. When you go through a bank, they typically will, again, direct you to an advisor. There's bank advisors. There's also advisors who are self-employed and outside any sort of bank or institutional ownership. That's really probably where most doctors will have their insurance, through those sorts of sources. And then in super funds, most superannuation funds have some default cover. And you can actually go back to your fund and say, can I increase it? Can I cancel it? A lot of people don't realise. Often you can just say, I don't want that insurance through the super fund. I want a different policy, and can actually cancel it.
Well, that's important too, because I've been told that you should cancel that super fund insurance, which is sort of the default setting, because it can interfere with your ability to access your other income protection. Is that right? If you've paid for a different policy.
There are pros and cons. What's probably more accurate, I don't know your policy specifically, but the cover through super almost always has an offset that doesn't allow a second payment from another insurance policy. So in that sense, it might be redundant to be paying for income protection in a super fund when you couldn't claim on both.
Right.
I don't know if that's exactly true to your state, but that's probably one of the most important things people need to be aware of with the super fund offerings. You can't top them up elsewhere, which can be a real problem.
It's quite tricky, isn't it? Because actually the amount that you get covered in those sort of covers is not very much, realistically.
Yeah, it's capped. So if you earn, using that example, $160,000 a year, you can basically insure for $10,000 a month. You still have to pay tax on it. So the super fund for someone in that scenario, maybe they do have an offering of $10,000, maybe it's less. Often it's a default level. It could be $1,000 a month. Sometimes that's the starting point. Now, if you go to increase that, you can, but let's say you've got private income, that may never get picked up in that super fund policy. Or if it's appropriate to have a second policy outside of super, and there are good reasons to do so, that cover in super, as I said, almost always is redundant. You can't claim on both because of the terminology of that super policy.
So I think that's a really important thing to know about, isn't it? So, and in terms of other traps, are there other sort of insurance traps that you need to be aware of?
Yeah, there are. Probably the most important thing is to look at the quality of the wordings, quality of the definitions. It's really hard for an individual just to work out what should it be. How do you know? You're not an insurance lawyer. You're not a lawyer, and you're
busy and you don't have time.
Exactly.
And
who has the
not
time?
That interesting,
Yeah, really. I thought it was pretty interesting, but yeah, no, I agree. It's just not. I mean, so that's really difficult to know what is a quality definition, and I've obviously got thoughts on that. But that's really the value of a quality advisor who understands these wordings. Mm-hmm. There's a lot of traps in terms of disclosures. So when I say traps, I just mean if you go about it the wrong way, you can really suffer at the end. So if you don't make appropriate disclosures and you withhold something that's material to the insurer, you might find in the future you go to claim and you can't claim. So dealing with the disclosures appropriately is really important. And people get stuck both ways. So some people, they don't remember what they've had. They seemingly just don't remember what their medical history is at all. That's really hard. The insurer does need to know your medical history. The other side of the coin is that people can be so giving them information that complicates things or actually isn't material to the insurer making a decision and just stops the process. So whether you saw your GP last 3 years ago and 3 months or 3 years ago and 2 months, it doesn't actually matter. What's important is what pathology do you have in your history, basically, and what sort of increased risk does the insurer take on by taking you? You need to let them know in order for your cover to be reliable in the future. And actually, one of my biggest critiques, as you might have said on the other video, is some of the direct policies. There's another option. Sometimes you get something in the mail, and I will be really critical of various medical colleges that effectively send this to their database and earning money often off the insurer to send these really low-grade policies out to their database. The biggest problem with these policies, and I'm generalising, is they have a clause that basically makes it very easy to get the cover, but if you've got a pre-existing condition, you're excluded for that. So if you've had high cholesterol 3 years ago, it's borderline, and you come in to claim for a heart attack, well, what happens? They actually say you've had a history of high cholesterol. That it gives them the ability to exclude because there's no actual disclosure process.
Okay.
So there's a problem with the wording and there's a problem with the disclosures.
You just bought a package.
Yeah, a package. That's really quite problematic.
Right.
I think.
Okay. So this might be a good time to ask you about advisors, because I think that doctors are inherently a little bit suspicious about the value of paying for these extra services. Sure. I mean, because this isn't about a salesy type thing.
Yeah.
This is just about
Right.
getting
Yeah.
information.
Yeah,
So,
sure.
where do advisors
Yeah.
get their money from?
Sure,
Like,
happy to answer all that. Firstly, just let me mention, doctors are targeted. Doctors have been exposed to lots of rorts over the last, I don't know how many years.
right.
So it's good to be a bit suspicious.
Yeah.
There should be more suspicion, I think. And because you're so time poor, things get through that may not get through with a lawyer, for example. So I think that's appropriate. As you're asking, I was thinking, let's just say I wasn't in the game. I moved to Canada, and as a friend, you say, who should I actually use? What do I look for? I mentioned in the last video, I think a referral is really important.
Okay.
I think the advisor you deal with really should have access to the broader market of policy. So let's say there's 10 major insurers. Can they actually place business with all 10? Can they show you the quotes of all 10? I think that's really quite important. If they do favour one or two or three insurers, they should give you a really good reason as to why. And I'm actually a bit cynical about some of those reasons. Often people say, look, I put every client with insurer X because they're the best on paying claims, and I doubt that. I doubt the individual advisor really has a big enough sample size to know that insurer is fantastic. I can comment actually, I think insurers generally are pretty good with claims in spite of some of the press that you see. I think they've got legal obligations and they've got moral obligations to actually pay claims, but you've got to do it right. So it has to be a valid claim. The disclosures have to have happened at the right time, and you have to pay your premiums, those sorts of things. But if that's been done, claims will generally either be black and white, easy to pay. And this brings me back to the advisor question. There are lots of claims that are actually just borderline. It's not clear, can the person really go back to work, or is it a partial return to work? And it just muddies the water up. So what advisors do in those scenarios, really, I think that's where they earn your loyalty, hopefully. But the problem is you may never experience that. You may never. You might be 70, you cancel all your covers, you say, thank you very much, it's been a fortune, you've been great. But, if you do have to make a claim in the meantime, I think that's really where they can add huge value. So ask around.
So, but what I meant by that question
Okay.
was, like, I sign up with an advisor, get an insurance policy, but I don't pay the advisor directly, do I?
Yeah, let me comment on that. That's right. No, generally don't. There are advisors who will, firstly, let me just comment, there's commission, or the politer term is brokerage. So generally speaking, those 10 major providers all have policies that you can go and call up and go online potentially and just buy it yourself. Then you can go through an advisor, and I'm generalising, but the premiums are the same if you go through the advisor. However, the insurers have an arrangement with the advisors to pay them for the work that they do in assisting you. That's generally how it works. There are some advisors who charge fees on top of that. There are some advisors who may not work on that commission basis. They might do other services, for example, and then they might cross-subsidise the work that they do.
But if they have access to all 10 insurers, they shouldn't really have a bias. There's no real, reason for them to do a hard sell or anything.
Yeah. The cynical response is, well, hold on, if one policy costs you $5,000 a year and there's another one that's 6 or 7 or 8, well, maybe they're going to try to convince you to go for the 6 or 7 or 8. And there are. I could do a quote. Some companies would come up at 5,000 a year, and some will come up at 10,000. I get asked often, like, what's the difference? And there might be differences in the policies. So that's why I think it'd be good for you as a consumer to see, well, show me the 10, and why? What's the reason you're going for that one?
Yeah,
I think that's important.
Yeah, that's good advice. So, what's the right time to get insurance then? If you're thinking about it and you're a junior doctor, or maybe you've gone a few years without insurance, what's the best time to get it?
Maybe I'm biased, but I do think getting in sooner is better, and I'll explain why. But the real heart of the answer is, are you financially independent? Are you aspiring to that? If you have a mentality that other people are looking after me, you probably won't actually physically go out and do this. It's when you realise, no, I need to look after myself, I'm an adult, then this becomes an important thing to consider. Now, it is really unlikely that a 25-year-old or a 28-year-old is going to need to claim on a long-term, they're not likely to die, they're not likely to have cancers, they're not likely to have substantial time off work. And that's actually reflected in the price. So for those sorts of demographics, they might only need to spend $500 a year or $2,000 a year. Some of that can be, in fact, all of it can potentially be paid from super. So I don't actually think, it's just, I can't afford it. And I do hear this from younger doctors, they don't pay me much, I just can't afford it. And I get that. There's buying your first house, buying your first car, just living. It costs a lot, so I understand that. But I actually think we're not talking huge dollars, and you can use super just to fund it.
And
so
it's
now
tax deductible too, isn't it?
Yeah, usually, income protection is tax deductible. Life cover and TPD can be tax deductible in part. It's a bit more complicated. I'm happy to share that in other videos, but a lot of it can be tax deductible. So to answer your question, when is it good to do? I actually think if you don't have the cover and you're taking your responsibility for yourself, now's the time to do it.
Okay.
We all get busy, so you might put it off for forever and a day, but now's the time to at least take some steps.
Well, yeah, in our situation, we really regretted not having taken that step because it would have completely changed everything for us, the way that the subsequent sort of 10 years have unfolded. So with that in mind, well, I guess the other thing actually is to say that with increasing age comes increasing risk of illness. So if you've got some sort of a diagnosis or if you develop an illness, which may not be sort of a threat to your career per se, but if you do have a particular diagnosis, for example, you get diagnosed with diabetes or depression, that can also limit your access to funds, can't it?
Sure. So that's another big imperative to get cover early. If you have a health issue at the time you go for cover, you've got to disclose it, and they're likely to either charge you more, exclude certain things, or just deny you from getting cover. Right. I got type 1 diabetes at age 21. I pay an extra 150% for most of my cover. I've been denied getting certain types of income protection, for example. So I don't really have the ideal cover. Well, I don't have the ideal health, and I actually accept that. But I wasn't going to go get cover at age 19 or 20, but that's a good reason. There's lots of good reasons to get in earlier to do that. I definitely think so. And similar, we touched on level premiums before. If level premiums are a good option, you want to really lock in that low premium as soon as possible. I'll often meet doctors who set up a level premium 10 and 20 years ago, and whilst there has been movement in the market, they have been bumping up in recent times, I generally look at it and go, wow, there's nothing that even compares to what that person has on that level premium because they set it up so well 5, 10, 20 years ago.
So getting that level really early is actually really key to setting
Usually,
yourself up
I wish just to say yes,
yeah.
because I've seen people where it didn't work for them for certain reasons. It's a bit more complicated than that.
Right.
I do level on almost all of my policies. So if I compare, I'll just speak personally. If I compare my policies to the market, I can't get better, even aside from the diabetes thing. I've locked in rates that I can't replicate elsewhere, so it can be very advantageous. It also makes my insurance much more affordable into the future.
Right.
So it can be really good, but there's some traps with that as well.
Okay. So a question that comes up really often in a lot of the Facebook groups when we're talking about income protection is how much should I be paying for good quality cover? So I thought maybe I'd just pick your brains about a few different sort of stages of life and how much you'd expect to pay at each stage. So let's say you're an intern, 25, 26, no health problems, and you want cover that's comprehensive to the age of 65. How much would you expect to pay a year for income protection?
Sure, I'd say it depends on which covers you go for, but if you're healthy, I'd say about $500 a year would be a starting point, up to about $1,500 depending on how comprehensive you go for.
Okay.
Just as a ballpark figure.
Okay.
That would be for typically 75% of your income. The waiting period might determine a lot of the cost. And then, look, often in that scenario, people aren't going for a lot of life or TPD or trauma at all. But at least starting with income protection, that gives you an indicative.
And so if you adjust your waiting periods, that's something you just talk to your advisor about?
Look, you can decide yourself. You can get quotes if you're with an insurer, even with a super fund. You can say, well, what is it for a longer waiting period? But that's right. I think it's best to talk to someone who actually understands how it works. I mean, we find sometimes... I've seen examples with some providers where the 30-day waiting period is just getting too expensive, and we go get a quote to go to 90 days, and that comes back as whatever it is. But the 60-day waiting period with other providers is sometimes better than the 90-day.
Okay.
That's where the advice comes in and understanding the market.
Okay. And so then next level, let's say you're a registrar around the sort of 30 mark, thinking about buying a home, haven't had insurance before. What sort of would you be expecting?
It wouldn't be massively different in terms of what the cover they would go for necessarily would be, but because the need hasn't jumped up drastically. Yeah, so I'd say maybe add up to 100% on what I just said. So 2,000 to 4,000, for example. Okay. And I should mention, by the way, I'm quoting in my head stepped premiums. So these will go up and up over time. If someone comes in and goes, yep, I want level premiums, you probably have to double those starting points as well.
Right.
Which most people won't do. If you're earning $120,000 a year, you won't say, oh, okay, I'll just spend $4,000 a year. You're unlikely to just go, I'm going to spend $4,000 or $5,000 a year.
But you should, so you can lock in that amazing initial rate, shouldn't you?
You should, but everyone's got their mobile plans, and just filling up your car costs $100 and want to go on holiday. So you're competing with other interests that that demand people's money. But
you would be encouraging level.
I would at least make people aware, but I'm actually quite realistic. It's like a patient who isn't really going to take all the medication you prescribe, but you might get them to do part of the treatment. Work with that, but at least advise them. Not a good idea?
Not a good idea.
Okay.
No, I'm joking.
Sure.
No, I get what you're saying.
Being pragmatic. People who don't want to spend anything, giving them some options that are palatable for them, I think, is important.
But if you're super anxious like me and you think, I want to lock in that awesome premium to start with at the beginning, then you'd be paying maybe $4,000.
In that sort of
for a really good cover as an internal resident, registrar. Okay. So then the next level, let's say...
I'll just touch on that. So when you take on the debt, there's a couple of things that really trigger more cover being required, in my opinion. You take on that first mortgage and you're having a child. So both of those are going to really potentially mean that more cover is required. Mm-hmm. Then you have to factor in what's the other person in the equation, the other adults in the scenario earning. What are their requirements if you're off work? So it really starts to be very individualised. Mm-hmm. If you pass away, does that other person just keep on working, or maybe they're not working? It gets more complicated.
Okay.
Does the child have special needs? So, how long's a piece of string? But to give you a ballpark figure,
but just on income protection,
intern,
resident, registrar, I'd be looking to pay up to around $4,000 on
sort of the upper level. Yeah, I'd say so.
Yeah. Okay.
Assuming they're healthy. Because what I'm working on is I've got an idea what the earnings are, and I've got an idea what the age is. Mm-hmm. So that's getting quite easier. It's going to get a lot trickier as we go to becoming a fellow and private and different specialities having very different incomes. Mm-hmm. Part-time, full-time, it's going to now change drastically.
Okay.
That's the next step.
So let's jump in. I know it's going to be very hard to estimate, but let's jump in and say you haven't had cover until you've hit 40.
Yep.
Let's say you're a surgical trainee, you didn't have time, and at the age of 40 you've fully qualified and you want to jump in and get some cover. What would you then be expecting to pay taking out a new policy for income protection, assuming that you're otherwise healthy, you want cover till 65, and it's just income protection?
How much cover are we going for? Like, how much per month do you think we're insuring for? Actually, I'll give you an example. Often, for newly qualified, $15,000 a month is probably the standard amount that people go for. Now, just as a quick aside, if you're earning less than that, normally you can't insure for 15, but almost every insurer, every one of the major insurers will say newly qualified specialists are entitled to $15,000 a month guaranteed. So that's a unique thing that they actually give you, knowing your income, your earning potential.
Okay.
So that's probably a good indication. Now, people sometimes say, I want more than that, and that's fine, but subject to their financials, they might be able to increase it. Mm-hmm. But if we work on that, I would say, if someone's in their 30s, they might spend, again, maybe $3,000 a year to $6,000 if it's a level premium, something like that, assuming medically all clear.
$3,000 to $6,000.
Yeah, I think so. On the income protection. Yeah.
On income protection.
Yeah. So $3,000 might be the stepped premium.
Right.
But if you want to lock in the rate based on age, then it might be double that, about $6,000, just as a quick ballpark figure.
Okay. And then sort of
Tax deductible.
all tax deductible. And then getting to sort of the later end, if you're sort of 50-ish, would you be taking out new cover? Like, do you think it's worthwhile?
Depends on the person's need. So if the really difficult thing is, I'll just give you my philosophy. Some people are pretty wealthy and they actually could retire today. In fact, I met an orthopod last month. He has millions of dollars of assets, he's not my client. He had a lot of insurance, and at the end of the conversation, it was clear to him he doesn't need this.
Right.
He doesn't need to pay $50,000 a year in insurance.
He's not a respiratory physician. He's an orthopod.
Yes. So I fully respect that.
Yeah.
Because yes, you could insure it. What if you're off work? But there's not a need for him at that point. Now, not everyone ends up in that scenario, but I guess if for financial reasons you need to keep working, then I think you need income protection. And in my opinion, a lot of the medical people working in 60s and even 70, a lot of them actually, from seeing it behind the curtain, they actually do need to keep working. So if you need it, then I think it's appropriate to have it. If you don't need it, then that's okay. Then you self-insure.
Okay. All right. Well, thank you very much,
A
Aaron.
pleasure.
I think that's a really good place for us to stop. But certainly if there are any other questions that people have, anything that we haven't addressed about income protection or any other kind of insurance, Aaron's very kindly offered to help us out with those questions. So please feel free to either email us through the website or contact us through the Facebook page. Next time we're going to drill down into other forms of insurance and look forward to seeing you then.